Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings and uncover the hidden stories within them. Today we are diving deep into the Innovation Access Fund's latest registration statement, and let me tell you there are some very interesting details about how this fund plans to make money and what risks you might face as an investor. We will look at how they plan to invest, the fees involved, and of course, the risks. Before we jump in, if you appreciate getting straight insights from corporate documents, make sure you are subscribed and hit that notification bell so you do not miss any of our deep dives. Also, we have a fantastic community growing on our Discord server where we talk more about these types of filings. So check out the link in the description below. So what exactly is this filing about? It is essentially a registration statement for a new investment fund called the Innovation Access Fund. They are going public, or rather they are registering with the SEC to offer shares of beneficial interest. But here is a little twist. These shares are not being offered to the general public. They are only available to accredited investors and qualified clients, which means people with a certain amount of wealth and financial sophistication. This is not your everyday mutual fund offering. This fund is set up as a Delaware statutory trust, and it is registered as a closed-end management investment company. That means, unlike a typical mutual fund, you cannot just redeem your shares whenever you want. You are essentially buying into a company that will then invest that money. The fund's main goal is to achieve maximum capital appreciation. In plain English, they want to grow your money as much as possible. To achieve this goal, they plan to invest at least 80% of their assets in securities of innovation companies. These are companies both in the US and abroad that are in technology or related sectors. The idea is to find companies that can innovate and grow faster than their competitors. Driven by technology, they are looking at both privately held companies, known as the private sleeve, and publicly traded companies, the publicly traded sleeve, aiming for a roughly 50-50 split between these two. There is also a small portion, about 10% targeted for cash or cash-related instruments. Now, let us talk about the risks, because there are many. Investing in this fund means you are taking on a high degree of risk. The fund is considered a speculative investment and you could lose all of your money. Since it is a closed-end fund, your shares are not easily redeemable. There is no immediate plan to list these shares on any exchange. So selling them might be quite difficult. They do intend to offer a limited repurchase of shares quarterly, up to 4% of the net asset value, but there is no guarantee they will buy back everything you want to sell. Plus, there is an early repurchase fee of 2% if you decide to sell your shares within a year of buying them. Let us look at the fees because these can really eat into your returns. The fund pays its investment advisor, Silver Bay Capital Management LLC, a management fee of 1.25% of the fund's net assets annually. This is a pretty standard fee for a managed fund. But here is where it gets interesting. They also pay an incentive fee. This is a performance-based fee equal to 15% of the fund's net profits. This means the advisor gets a cut of the profits, which can incentivize them to take on more risk to generate those profits. This incentive fee is a big deal, and it is calculated on a fund-wide basis, not on an individual investor's experience. The fund offers different classes of shares. Class A shares have a maximum sales load of up to 2.50%. Class W shares are for investors in wrap fee programs, and Class I shares are for institutional investors or wrap fee accounts with a minimum investment of $10 million. The difference is mainly in the fees. Class W shares have a servicing fee of up to 0.25% annually, and Class I shares have no additional fees beyond the management and incentive fees. Looking at the expenses, Class A shares are expected to have total annual expenses of 2.37%, Class W shares at 1.77%, and Class I shares at 1.52%. This is quite high, especially considering the incentive fee can add even more to that. Remember, these are just estimates and actual expenses could be higher. The expense limitation agreement helps cap some of the ordinary operating expenses, but it excludes several key fees like the management fee and incentive fee. The filing goes into a lot of detail about risks, and it is important to understand these. They talk about market risks, general economic conditions, and of course, risks specific to investing in technology companies. Because they are focusing on innovation and technology, they are subject to rapid changes in technology, obsolescence of products, and investor sentiment, which can be quite volatile for these types of companies. Investing in technology companies is inherently risky. These companies often have limited operating histories, and their products can become obsolete very quickly. Technology spending can also be cyclical, leading to inventory write-offs and operating losses. There is also a shortage of skilled personnel in this field, and patent lawsuits can be a problem. Investor sentiment towards technology stocks can also swing wildly, affecting stock prices. A big chunk of their strategy involves investing in private companies. This is where things get really tricky because private companies are not under the same scrutiny as public ones. They do not have to report to the SEC regularly, their accounting might not be up to par, and they might not have strong internal controls. This means the fund might not have timely or accurate information about these companies. Private companies also tend to have fewer resources, shorter operating histories, and are more vulnerable to market downturns. A significant issue with private companies is valuation. Since there is no ready market for their shares, their value is determined by fair value as decided by the board. This process involves a lot of judgment and can be quite uncertain. The information available about these companies is often limited, outdated, or difficult to confirm. This means the fund's net asset value could fluctuate significantly, and investors might buy or sell shares at a price that does not accurately reflect the true value of the fund's holdings. This also impacts the fees paid to the advisor, as the incentive fee is based on these valuations. The fund can use leverage, meaning they can borrow money to invest. While this can boost returns if investments do well, it magnifies losses if they do not. They can borrow up to 33.33% of their total assets. This practice is speculative and increases the volatility of the fund's net asset value. If the value of investments drops suddenly, they could face a margin call and be forced to liquidate assets, potentially at a loss. This incentive fee also creates a potential conflict of interest. It might encourage the advisor to take on riskier investments to maximize profits, and by extension their bonus. The fee is calculated on a fund-wide basis, so even if your individual investment does poorly, you are still affected by the fund's overall gains and losses as they impact the incentive fee. Here is another unusual risk factor. If the fund does not manage to do a qualifying tender, meaning they do not repurchase 100% of the shares tendered in a repurchase offer, for 2 consecutive years, they will not make new investments in private companies. They will hold onto cash instead to satisfy future tender requests. This could significantly impact their ability to achieve their investment objectives and implement their strategy. The fund's advisor, Silver Bay Capital Management LLC, and its sole member, Alkeon Capital Management LLC, manage other accounts with similar investment strategies. This creates potential conflicts of interest. They might prioritize certain accounts over others when allocating investment opportunities. Especially with limited opportunities like private placements, while they have secured an exemptive order from the SEC to co-invest with these other funds, there are still conditions and approvals required, and it means that the fund might not always have access to every opportunity. So, what is my take on this filing from the Innovation Access Fund? On the one hand, the strategy of focusing on innovation and technology companies can offer significant growth potential. The focus on both private and public companies allows for a diversified approach within their chosen sectors. However, the high fees, particularly the incentive fee, are a significant concern. Coupled with the inherent risks of investing in private companies and leverage, this fund appears to be geared towards highly sophisticated investors who understand and can tolerate substantial risk and illiquidity. The valuation challenges with private companies are a major factor to consider. The company's direction seems clear, aiming for high growth through innovation. However, their significant reliance on private company valuations, and the potential for conflicts of interest due to their advisory structure and management of multiple funds introduce considerable uncertainties. The limited liquidity and repurchase options also mean that investors need to be prepared for a long-term, potentially illiquid investment. It is a high risk, high reward strategy, and while the potential upside is there, the downside risks are substantial and clearly laid out. This is not an investment for the faint of heart, and thorough due diligence is absolutely essential for any potential investor. Alright, that is our deep dive into the Innovation Access Fund's registration statement. If you found this breakdown helpful in understanding what this filing means, please give this video a thumbs up. It really helps the channel, and if you want more breakdowns like this, be sure to subscribe and hit that notification bell. Let me know in the comments what you think about this fund strategy and the risks involved. Also, don't forget to join our growing community on Discord, link in the description below, where we discuss these filings in more detail and share insights. Thanks for watching, and we will see you in the next video.